having a great day, great week, wherever you are and whatever day it is for you. It is Friday on the podcast, so we're bringing that good Friday energy to you. It is mid-February here in Seattle, so we do have clouds, unfortunately. But like you guys know from the last episode, I just got back from sunny California. We went to Disneyland with my 3-year-old daughter. It was the best time ever. It is at Disneyland. Last time I was there was probably 20 years ago. I was in high school, and it's not. There's nothing like Disneyland looking through the eyes of a toddler. They absolutely love it. I had a blast. So I'm super excited to jump back into it, though, because we got Mike Zlotnick with us on the show. Mike is from Tempo Funding. He does a ton of stuff. If you can think about it, he probably does it. But right now, he's focused on industrial and open air retail. I am super excited to jump into this. Mike, thanks for hopping on.
Gabe, thank you kindly for having me. And we all get excited about Disney. And you are in the Seattle Tacoma area, and I'm in Brooklyn, New York. And we all complain about the weather. We just had that massive blizzard, and it's been not exactly fun, but it's part of life of living in the northern parts of the country.
Yeah. I mean, the summer here in Seattle, you can't beat it. But when we went down to Disneyland, it was actually it was raining the first day, and we were like, oh no, we brought Seattle with us. But the next day it was sunny, so we were all good. Mike, I told you before we got on here, we always like to start with stories. We like to hear how people got to where they are. So why don't you take us to the beginning of your story in real estate and just tell us how you got here?
So you see my Cub Buffalo Bills.
Nice.
Congratulations, by the way, to Seattle for winning a Super Bowl. So I come originally from the former Soviet Union. I immigrated in 1989. I was 18 years of age. I grew up playing chess and being a math wizard. Came to the United States, political refugee. I became U.S. citizen, U.S. patriot. I settled upstate New York, actually in Rochester, New York. And that's how I became Buffalo Bills fan, just kind of upstate New York.
Nice.
But to make a long story short, I being a chess master and a math wizard, I studied math and computer science here, upstate New York, and basically went into the technology world. I spent almost 15 years as a rank and file tech guy, all the way to a VP of corporate VP, running multiple departments. Had a great career, really enjoyed it, but also discovered passive real estate investing in 2000. Bought my first apartment in Brooklyn, New York, and continued to buy some apartments and some multifamily homes here in Brooklyn, all local, all near where I live, and discovered appreciation, but no cash flow. So, and it took me only 9 years to be a passive investor to get to the point that I wanted to take the leap and be done with the technology career. And I was getting a little burned out. For those who are in the tech world, can appreciate midnight deployments and things that have to be up and running. The software has to be perfect, but by the 7 a.m. clients come on board. So all that experience with a little bit of a burnout, and I was delighted to jump to real estate full time. Was my passion. I really loved real estate, and it was right after GFC 2009, and there were all kinds of interesting opportunities, and that's kind of how Tempo Funding was born. Started financing short sale flips. If you remember those days in residential real estate, ton of properties needed. There were a ton of inventory, deep discounts. You could buy phenomenal deals, and a lot of people that we kind of knew needed capital to finance. You could buy, take a property to be worth $1 million. Now it's worth 500,000, and the bank loan is 700,000, and was a short sale, and they would buy it for 450 and flip it for 500 to a retail buyer. They needed the 450 to finance their short sale purchase and then immediately flip. So we start funding flips, and then start funding hard money loans, and sort of the journey continued from there into commercial real estate over the years. But I'm going to stop for a second, and just about couple of words about my family. I live in Brooklyn, New York, and married to my wonderful wife for many, many years. We have 4 monkeys and a cat, 4 human monkeys.
Nice.
And a real cat.
Nice. Well, I love it. That sounds like It's funny that you mentioned you kind of got burned out in the IT world. I got started in consulting, and we did those midnight releases, and that is it is a rough world, and so I understand why you'd want to jump into real estate from that. Um, so
Freedom
you've
of
done.
time. That was the freedom of time requirement. Financial freedom, I was almost there already. But the freedom of time to do things normal hours and let the money work for you at night, not worry about the software deployment calls, that was the transition. That is a key. Like, we all have a why, right? My why is to empower investors to achieve financial and freedom of time through passive real estate.
Yeah.
But it takes a leap of faith to make the jump. It's not easy because you get used to it.
When people talk about financial freedom, I feel like that is the type of freedom that they're actually talking about, is just the freedom to choose who, what, and when they actually, engage in work. Nobody wants to stop working. They don't, people might think, they might romanticize the idea of not working, but that's not really what you want to do. You want to work. Work is fun. You just want to be able to choose when you do it, where you do it, and who you do it with. And so, yeah, I totally understand that. So after after the 2009 crisis, you guys got into real estate pretty deep. You started funding deals, but then you started buying deals again. You started getting onto the kind of the GP side. You've Up to now, you guys are focused on industrial and open air retail. Why is it that you chose those two asset classes?
We've still done a bunch of other things too. So, but those are the darlings we love today. So we've done open air, retail, and industrial all the way back to 2017. But we've also done multifamily, storage, other projects. I'll just tell you, many of us have seen what has happened to multifamily through the higher for longer interest rates and that reset. So
Four caps, those just insanely low cap rates.
it was a darling of commercial investing, and it got devastated. So it's a battlefield now for many of these deals to survive, and we continue to do actually reasonably hard work to try to make sure these deals survive and ultimately, hopefully, thrive. But some of them are losses, no matter what. And what we saw over those years, I kind of
And
thought about.
pausing there real quick, you said some of them are lost no matter what. And the only reason a deal is ever lost is because you didn't buy right. And so I just want to pause on that because these people, and I'm not throwing shade or anything like that, but when you buy on variable rates, at some point the interest rate can change, or your loan comes due, and you're projecting for rent increases that don't actually materialize. If you're underwriting on such a slim margin, such a razor edge, that's when you get caught. So I always suggest and push people to stick to their underwriting and buy right. Really book in that the little bit of cushion that you can get, because if something, you never know what's going to happen in the economy. Things can change on a dime, and you don't want to be caught in that situation where a lot of multifamily operators are right now. But anyways, continue, Mike.
Yeah, so that you covered a lot of key points I was going to mention. So buying in 21, 22, market was approaching the peak or at the peak, and you either sit in your hands and you sell everything and you realize you're cyclically at the peak of the market, and the margin of these acquisitions was you are cost per pound at the peak of the market. A lot of aggressive assumptions, obviously interest rates and floating rate debt. So all these projects got devastated for just the financial pressure alone probably hurt too many of them. But the other thing happened is obviously COVID. You had the insurance premiums, labor and material cost spikes, and oversupply, right? Overbuild. So it was like a perfect storm. Can it happen? Yes. And kind of lessons learned, of course, exactly what you said. Buy deep, and if environment is not conducive of buying deep, don't do anything. Like, just wait for better timing. But at the same time, we saw all kinds of success with open air shopping and industrial. No supply, very low leverage, conservative leverage, fixed rate debt, all these safety elements that you look at. And the conclusion from that positive experience is that let's continue to do what is conservative, what generates predictable passive income, because many investors can't tolerate the pain of loss is just too big. Most people don't take it very well. So how do you avoid those situations? You got to get significantly more conservative in your investment philosophy, and that's why we shifted, especially in the recent years, to industrial open air shopping. Although we've done deep value buy multifamily at a 9 cap purchase about a year ago from a distressed seller that had to take a 35% haircut on the price, market reset that much. So when you find these type of situations, you can still transact, but at the same time, we've shifted our mindset to focus on predictable, safe, cash flowing. And the other key element, I use this approach to thinking about investing. So I basically use lease duration as a driver of predictability versus volatility. It's the best way to think about it. So when you have long-term leases, which is very typical in industrial or open air shopping, you got a Starbucks 10-year lease, or you got a Cheesecake Factory, they sign long leases. You have a lot more predictability of the cash flow today and predictability of rent growth. And they are triple nets. So the tenant pays for all the cost inflation, which has hit us pretty hard. So that shift is not just monthly rents, right? You go to monthly rents, which are Airbnb, which are self-storage facility. There's a number of asset classes that live on monthly rents. Yeah. Nothing wrong with that. When the market is good, you could continue to push rents up. But also, if somebody builds a facility near you and a price wars start, then you are unfortunately in a bad shape.
And that's one of the reasons I love, I buy self-storage, and it is an asset class that I will continue to buy. But right now, that's one of the reasons why I'm not just finding any deal. I'm just, it's not that I'm not buying it. It's just that I'm not finding deals, because a lot of self-storage has been overbuilt. The net rentable per capita in a lot of areas, especially Texas, which is where I like to look at, it's just way too high, and people have overbuilt. And I've actually had it happen to one of my facilities where I bought a facility and then a new construction went up literally 2 miles down the road. And, storage is a 3-mile radius that you're looking at when you look for lease ups. And so this shot the net rentable per capita up by, I don't know, it's like 16 or 17. And so it's things like that can happen, especially with asset classes like storage, where you have really short leases. Like you mentioned, you have a month-long lease, and people, if something goes up across the street, they have huge discounts that you can't support. People will just move right over. So I totally understand where you're coming from when you say you like long leases, which is, industrial retail. That makes a lot of sense.
Yeah. Thank you. You just covered a critical case of why, we're a little nervous about these short duration leases. Then you go to multifamily annual leases, and then same issue applies, that you got to keep re-renting them. You got to operate the assets, heavy operating businesses. We want to be investors, and to be investors, we're going to these classic long-term leases. So, open air shopping, you can have 10, 15-year leases, credit quality tenants. And then you go to industrial, you can get similar 5, 10-year, or you can get longer term. I mean, we just did a deal in Newcastle, Indiana. It's a private equity acquisition of a 100-year-old stainless steel company. And it's an immediate sale of a real estate and lease back. So what we got a private equity sponsor who bought the business, sold real estate, leased back, improved their return on capital as a result. And to us, it's a 25-year fresh lease with a wonderful tenant. And that's triple net, annual rent growth, 2.75, fixed rate debt, no volatility. It's like a clockwork. Just like a bond increasing coupon every freaking year. I don't know how else to put it. And your appreciation is forced through the growth of NOI.
Yeah.
That's it. And if interest rates come down, it'll be tailwind to everything, including this asset class. If interest rates stay where they are, it's fine. Even if the interest rates increase, we model that. You're fine too, because it's very predictable. And the other beauty, and I think of it this way, and going back to storage, we can't find any deals either, because they trade still at a negative spread between the cap rate and the interest rate. And in industrial and open air shopping, we're getting 2% or higher positive spreads,
Yeah.
which is a margin of safety and strong cash flow.
Yeah. I will. You mentioned you like for industrial and retail, you like how long the leases are. I will say that that is one of the reasons why I like mobile home parks. Not that their leases are long, but they are incredibly sticky. And so once you get a tenant in there, they own that house, and they're. I mean, they could move, but it'll cost them $10,000 to move that unit to another park. And so generally, though the leases aren't themselves long, the duration of stay is incredibly long. And so I get that inclination to go towards just things that don't have a lot of turnover. Storage has a ton of turnover. It's one of the reasons why I'm not super keen on it, but I do like storage. It's very easy to operate remotely, but it is, yeah, there's definitely downsides to it. But I haven't bought industrial yet. It sounds, triple net. Everything you just said sounds awesome, especially with a 2-point spread between your interest rate and your cap rate. If that's what they're trading at right now, that's that's a 9 cap, isn't it? Because interest rates are at 7 right now.
No, they're meaningfully better. So just give you an example of that deal we did in the Newcastle, Indiana. It's 8.6% cap rate on purchase and 6.5 fixed rate debt. And
Oh wow.
our timing wasn't ideal. We were supposed to get 6.3. We closed and the interest rate was a bit higher, and now it's come down. If we were locking in right now, literally a month later,
Yeah.
it'd probably be 6.25 or 6.3.
Yeah.
A little
It's one of those
volatility,
things. It's really hard to time out.
but you're still very solid shape. Even at 6.5, it's a very solid shape. And yeah, so and by the way, I heard that on a mobile home park. People moving the mobile home is incredibly expensive. They're more likely to sell the property, right, and to move on. Then you really don't have to worry about the tenant turnover. We just got a new owner, so
Yep.
I absolutely appreciate that.
Yep. Awesome, man. Well, hey, I just took a peek at the clock. We have run it down, but before we move on to the quick question round, I do want to ask about the book that you've been writing. You mentioned before that you're kind of gotten all your best ideas and you're putting it into a book. Tell us a few of those ideas and how the book's been going.
Sure. So it's my second book. It only taken me now 2.5, 3 years to finish this one, and I keep striving for perfection. It's super hard. And every time I touch it, I keep making some improvements and modifications. And that's, by the way, one of the key lessons in the book. People have asked, how do I get started investing in passive real estate or commercial real estate? And I start ready, fire, aim. Unless you're a sniper, you need to go ready, aim, fire. You have one shot, right? As an investor, you definitely need the iterative learning process. There's two elements in this. So one is ready, fire, aim. Very basic lesson where you just start and you learn from your experience. One of the most important things is the mindset, learner's mindset. I love to ask this question. It's a probing question. Are you investing to learn or learning to invest? It's always both, right? So most people prepare. How do I get in commercial real estate? Well, you go through a process. You learn about opportunities. You learn about diversification. You learn about capital allocation. You learn about different strategies: mobile home park, self-storage, retail, industrial. All those things make a lot of sense. You just got to figure out what you like, and then the book also talks about some very basic concepts I came up with: investment quadrants. So it's very simple. Robert Kiyosaki has his quadrants. I have my quadrants. And imagine 2 dimensions. One is called cash flow dimension, and the other one, or axis, cash flow axis, and then you have the safety axis, risk versus high risk versus low risk. So if you're looking for cash flow and higher safety, in my methodology, you're in quadrant 1. If you are looking for opportunistic growth, ground up development, well, you're in a quadrant 4. It's growth and it's a higher level of risk. And every deal falls into one of those 4 quadrants. The concept is to give people a very simple tool to look at every deal and to think, does it fit my plan? So the book is also obviously about building your goals first. Obviously, risk tolerance, your time horizon, your cash flow needs, liquidity needs, a number of other factors. So that's an important question. And the other, some of the other concepts that I'll mention is, I talk about, just like the book, sometimes you win, sometimes you learn. So if you've gone through that experience, multifamily, you had a couple of investment cars, you don't know how things gonna play out, don't get discouraged. As long as you continue to diversify, yeah, if you invested a lot at the wrong time, it's incredibly painful. I had conversations with people literally early in the week where I had a discussion with an investor. He said, last cycle I lost 2/3 of my net worth. I had conversations with people who lost 90% of their net worth. I know people who have done this. I'm sure you heard
Yeah.
this story. They started
Yeah,
early.
we've had people on
They
who
doubled
during
down every 3 years.
yeah.
So they imagine if you take $1 million, 3 years later you have 2, 3 years later you have 4, 3 years later you have 8. You've done it through the growth, through that great expansion, and that comes 22, and you don't want to pay taxes, and they rolled all the money in the next set of deals not to pay taxes, and then the market resets, and so these things have happened, but you gotta learn your lessons. You gotta continue to come back to the basics and build a strong foundation. And that's what the book is about. It's just to give you a framework. And I'm a chess master, so the book is really applies the learning methodology of how do we learn in chess. And this is such a typical classic way for people to think about this. It is applicable by many other investment gurus, but in chess, before you play the game, you study, you prepare for the game. So it's preparation component. And 2, after the game is over, you analyze your game, and then you analyze games of great grandmasters, and you learn through that iterative process. This is how you get better. What happens in investing? Exactly the same. So I study Ben Graham, Warren Buffett, Charlie Munger, Howard Marks, Ray Dalio, all the classics. So I use many of their wisdoms as part of the book, quoting them, of course. But these are such a simple, fundamental lessons. And when you look at real estate, most of the fortunes, well, until you had the AI boom or crypto boom, were built slowly, predictably over time in real estate, right? Of course, you could build fortunes fast through crypto or through AI. That's a lot of it is speculation. If you're right, that's wonderful, but that's not investing. That is speculation. And sometimes people say, but it's better be lucky than good. I say, it's better be. You got to get good, and if you're lucky on top of that, that's wonderful.
Nice, awesome. So if people want to get involved in this book, how do they find it?
So people can sign up for early, get an e-copy once it comes out. It's going to come out fairly soon. It's on our podcast website. So people call me Big Mike for a long time, and I'm a fund manager. So the website is bigmikefund.com, and they can sign up. And I like to crack this joke, a little cheesy, but it'd be easy to remember. If you can't remember that, bigmikefund.com is a shorter version of it, right? People have actually misheard me, and I said bigmikefund.com. They didn't hear the D at the end. They said, is this the right site? Am I going to get the right place? And I'll tell you, if you go to bigmikefund.com, I promise it's not a kinky site.
That's a good way to make the distinction there. I like how you in your book,
it'll forward you to the main site because I own both domains. So.
There you go. I like how you mentioned, or kind of your theme in there is ready, fire, aim. Because really in real estate, I mean, you can read so much, you can watch a million podcasts, but you're not going to learn how to actually do real estate until you do real estate. The only way to shortcut that is to find a mentor, find somebody who's done it, and work alongside them. That's really the only way to get those insider insights in real estate. So anyways,
can I ask to this point? I just want to add something to this point. So having a mentor is critical. I agree. Mentor or coach, we all need at every stage of life having a mentor or coach. It is critical, no matter how good you get. The best of the best still get coach even at the peak of their career, especially top athletes. So that mindset is a critical requirement to continue to learn. But the simple methodology that passive investors can take, and active is a little different. People go to mastermind communities. I've been in multiple masterminds for years to get better and to learn. But as a passive investor, when you write a check into any deal, storage, mobile home park, industrial, open air shopping, anything, take the opportunity to be a little more than just a passive investor and collecting checks. Get the reports, read the reports, ask questions, get involved, understanding what's working and what's not working and why. And that will help you get better with the next decision.
Nice. I like it. All right. Well, with that, I'm going to push us into the quick question round. Are you ready?
Yeah, go ahead.
Let's do it. Starts with education. It could be any form, could be a book you've read, movie you've seen, mentorship program you've been a part of, anything like that. Just need 2 recommendations, one for general life wisdom and then one for real estate.
So start with why. That's a great book. Really, really powerful.
Sam Silinek or something like that?
Yeah, Simon.
Simon.
Yeah.
Silik or whatever.
Okay. Sinek.
There we go.
Let's start
Take
with
one of those, put them into Google. You guys will find it.
Yeah, the book I already mentioned. Sometimes you win and sometimes you learn. John C. Maxwell. He's one of the profound authors. There's a lot of fun, interesting books. I really like this book, Richer, Wiser, Happier. I think author's last name is Green, Mark Green. Phenomenal book. Really studies the lessons of some of the greatest investors like Howard Marks or Charlie Munger and others. So hope it's enough. That's the 3 books that some of the recent books. I'm a big fan of Ray Dalio's everything. So the principles of navigating big debt crisis, the principles of changing world order, very relevant. A lot of people looking at the U.S. dollar and U.S. government printing money. Are we running into a crisis? All that stuff is so well described by Ray Dalio.
Yeah, his books are, or I've only read one, the principles one, but it's pretty good. All right, next question is for your younger self. Let's go back to the Mike let's go back to the one who is just coming over to the U.S., just getting started. Go back to him, look him in the eye, give him one piece of advice moving forward.
Start earlier, investing in real estate. So the earlier you start, the better it is. Real estate seems to work really well gradually over time. So don't look for perfection. Especially when the market goes through some kind of correction reset, you're buying well, but even starting early and just getting used to it, the appreciation over years takes care of the business. I bought in New York City, not a really cash flowing market. People prefer to buy near where they are. Again, start early and learn on the way. That's the best advice that I would give.
And anytime somebody says that, it's in the bucket of I wish I got started sooner. Probably 80% of the guests come on and say that. So anytime they do, I always point it back to you, the listener. If you have not got started, go out there and just get something done. It doesn't matter what it is. Could be a single family, could be a piece of land, but just go out there, buy something and get started, because so many people that come on the show wish they got started sooner. And it's now is always better than yesterday. So awesome. With that, we are going to move on to the next question. This is about the U.S. It's a big place. There is a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
Wow, that's a great question. I wish I had a single metro. Unfortunately, I don't have an answer. Some people would give you a wonderful answer. Of course, you have your demographic trends and people migration trends. Probably Dallas, Fort Worth metro, just because people are moving from New York and from California. But you have to pay attention to what you're buying and the price you're paying, and the market can get oversupplied as well. Yep. So if you're talking about one metro for a really long-term hold, that's a great market. But at the same time, deeper value, you could find maybe Midwest. We found some great opportunities, as I said, in Detroit area. You can do contrarian plays. So It's not a single market. I would say there are many markets. But long-term trends, Texas and Florida seem to have gotten a lot of inbound capital migration and people moving there. They don't want to pay coastal taxes.
Yeah. DFW is a solid market. We have 2 self-storage facilities out there, and they're actually crushing it. And it's funny you mentioned Detroit. One of my coaching students is that's the metro that we're focusing on, and I had no idea how cheap houses and multifamily is out in that area, the Detroit area. I'm from Seattle. You're from New York. I'm sure our understanding of price per door is is a little bit different than what you can expect in those metros. So
On that
definitely.
topic, let me give you one live example. We bought 79,000 a door last year, deep value buy. What used to trade at 125 a door, and it's got, before any improvements, before anything, the in place rents were 1150 a door. So
That's
you can
crazy.
do the math.
It's better than the 1% rule. I love it. All right, next question is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So, what is your favorite way to generate leads and find new deals?
We do a little different, and that's why I will not give you the best marketing advice how to directly find deals. We actually play the role of we run funds, we raise capital, so we marry money and opportunity. So our deal flow does not come from us doing looking at 1,000 deals and then pinning it down to 5 that we do. We do something different from our perspective. We work with very established long-term relationship, vertically integrated operators in different strategies. We are capital partner. We are super LP in a matter of speaking. So our investors give us a check in our funds or one of deal syndications, and then we write a big check, majority of the capital in a given deal. So for us, the deal flow comes through the relationships. Give you an example. Right before this call, I was with a team looking at a flex industrial deal in Maryland, coming from one of our sponsors who we've done deals with in the past. And then they source the deals through their methodologies. So our approach is just, as a super LP, is to have these wonderful, strong sponsors with specialty, and they bring us deals. Once they filter them and filter them and filter them, we hear when they're about to put them on the contract, and the phone call we get, here's the deal, here's all the details, would you guys be interested to take part in this opportunity? So it's very different versus, I got to go look at the 1,000 deals or 200 deals and screen it. So I don't have methodology how to get the deals, but I know when I see a great deal, because they come to us and we look at small subsets and we pick and choose from a well pre-vetted subset.
Nice. I like it. All right, next question is about lessons learned. Not every deal we get into goes the way we expect it. In fact, pretty much every time something's going to go wrong, and that's when we get to learn a lesson. So, what was a deal that went a little bit sideways for you guys, and then what was the lesson you pulled from it?
So many lessons, right? I mean, we talked about cost basis and buying the right market and market cycles. So I would say, of course, Mastering Market Cycle. Howard Marks is a great book. And the lessons learned, if you buy at the wrong time because the market is at the peak, hard to fix it, right? You just got to get patient. But the most fundamental lesson you can have, and it's difficult to do, is overcapitalized projects have reserves, have margin of safety, and the best way to describe it is when you look at any deal, use Charlie Munger's approach. It's kind of funny how it works, but he says always invert, and avoid stupidity. These are funny words. These are fundamental things, but what the hell they mean? And they mean this: look at possibilities of loss first before you look at the upside. And this is what we changed the mindset. So how do you fix your underwriting at the beginning? If you are already in a deal that is not going well, not an easy thing to fix. So the solution is overcapitalize, conservative leverage. How can you lose money, right?
Yeah.
So if you start there, then you figure out what you can do on the upside once you figure out how to protect your downside. Yeah. I don't know if that answers the question, but we've learned that lesson. Just have more cash. Cash is the king, both to protect deals, and if you have great new opportunities, access to cash is incredibly valuable.
Yeah. We've covered that exact lesson many times on the show, how you need to have more capital at the outset than you actually think that you're going to need. I've learned this lesson the hard way myself. I know so many people have done it, where you buy a deal, but you don't have the capital. You haven't raised the capital. You don't have the capital in the bank to execute the plan, because things go wrong all the time. You're never going to know exactly what's going to go wrong. You can, plan till you're blue in the face, but you know, life has a way of just making other things go wrong, and so that's when you need that capital in the bank to keep the deal going forward. And the other point that you made there was you have to buy right. And I'm telling you guys, that is the thing. It doesn't matter what, like if a deal is out there and a broker put a price on it, $1 million, whatever, that is not the price. That is not what the deal is actually worth. You guys offer what you think the deal is worth. Most deals that I offer on are usually 20%, 30% lower than the actual asking price, because brokers, their job is to get the highest penny or highest dollar for that deal. And so you need to make your own assumptions, make your own assessment of the deal, and offer what you think it's worth. Anyways, with that, I'm going to push us on to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
Back to the bigmikefund.com website, right? I think there's a way to for you to sign up for the newsletter, sign up for the book. And again, if you're bored, you got nothing else to listen to, there's still Big Mike Fund podcast, right? And sorry for being a little self-promoting, but we don't do volume. We have great guests, and hopefully Gabe, you'll come on the podcast soon. We love to talk about all kinds of interesting topics. So go on the website. You can reach out through the website. I'm not sure if there's a scheduling link there, but you'll figure it out once you reach out. And beyond that, I don't give out my cell phone number. I don't take phone calls from strangers. People figure out how to reach out. By the way, don't ever send me a deal unless you have a wonderful referral. It's kind of funny. My rule of thumb, I never want to hear cold calls, cold anything. If there's no referral, my first question, who referred you? And if you don't have a strong referral chain, I appreciate you. I'm not a bad guy. I actually love to help people. But you can reach out, and if you need some help, I'm happy to try to see if I can do something for you. And the best thing is figure out who's the right mentor or coach for you, and we all just kind of like back to the basic wisdom. Will I be able to help you? Maybe. I do some coaching, but very, very few people, very, very selective. So try to help, but just do. And don't let obstacles stop you. And if you fall down, you run into problems, you lose money, or your deal doesn't go, learn and move forward. That's the ultimate wisdom.
Awesome. I love it. All right. I will put Mike's link in the show notes. So if you guys want to reach out, all you got to do is click the little more in the description. It's going to pull down that full description, and in there you can find his links. All right, man. That wraps it up. Thank you very much for hopping on the show.
Thank you, Gabe. Appreciate you. And thank you, everyone.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe, at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review, comment, anything like that. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.